Hello, students, and welcome to Acceleration Academy Day 3. I'm your teacher, Mr. Oza, and we are going to continue our topic, Achieving Financial Independence. Today, Day 3, this is my absolute favorite day of the unit. I told you that yesterday, I told you that on Tuesday, so let's jump right into it. Quick review from yesterday and the day before. On Tuesday, we talked about budgeting. What we're trying to do is create a surplus in our budget. All right? That means that we have more income than expenses. So at the end of the month, we have a little bit of leftover money. Yes, we have to pay for our groceries, we have to pay for our bills, our rent, all that important stuff, but we want to make sure that the money coming in our bank account is higher than the money leaving our account. That's what budgeting is all about. So what do we do with that surplus, this area right here? What do we do with that surplus? Well, we do three things in order to achieve financial independence. Yesterday, we talked about saving for your education. You can make yourself earn a lot more money with more degrees. So the first thing you should do with your surplus is create an emergency fund. The second thing that you should do is save for your education. The third thing that you should do is invest. I love talking about investing. You probably already know that. We're going to talk about it all day today. So I'm hyped. All right. What's the fourth thing that you should do with your surplus? You should plan out your retirement. And to be honest, when it comes to planning your retirement, you're just doing more investing. Okay, it's just that your investment strategies when it comes to retirement are going to be a little bit different. All right, so obviously we're going to talk about that on Friday. And you know, you've heard me say this twice already before. When it comes to retirement, we don't want to be the old person with the cane and sitting in the rocking chair. If we achieve financial independence in our 30s, 40s, 50s, right, it means something different to everyone, that term financial independence. But we are going to be chilling in our retirement, right? We're going to be playing basketball. We're going to be hanging out in nature. We're going to be playing video games, chilling with our family and our friends, all right? So, this is our goal for today. We're going to talk about the basics of investing, all right? And then we're going to talk about retirement on Friday. Here is a very important legal disclaimer, so please listen up. You've heard this already, but I'm going to tell it to you again. I am not a financial advisor. I am an English teacher. Do your own research before making important financial decisions. Talk to a professional if needed. Go to your local credit union. It's a great place to start. There's a couple of really good ones in Lawrence that I've mentioned to you already, such as Metro Credit Union, such as Merrimack Valley Federal Credit Union. All right? Remember, I'm just your English teacher. I'm a guy who loves to talk about money. I have spent years and years doing research on how to achieve financial independence, okay? All of the strategies that you're going to learn today, I do all of these strategies. Literally, I can teach you about what I have done in my personal life to make the most out of these investing strategies, okay? I have personal experience doing all of this, but I am not a financial advisor. I do not have a license to give financial information. This is for educational and entertainment purposes only. All right, so that being said, let's jump into our instructions for today. They should look awfully familiar by now. You're already working on the day 3 vocab assignment. You're in the middle of that document now. First job is to finish that document, day 3 vocab, all right? Once you finish that, take yourself a quick break, 5 minutes, grab your water, grab your coffee, get some fresh air, stretch out. Maybe don't look at a screen for a little while. Take a little break from the screen if you want, of course. And then you're going to jump into day 3 reading. Same thing as yesterday, same thing as Tuesday. You're going to read 4 short chapters of some nonfiction text. A lot of it I wrote myself. Once you finish that, you're going to take another quick break, 5 minutes, do your thing, get some fresh air. Once you are ready to roll for the final part of the day, you're going to do day 3 writing. You're going to do 2 paragraphs, 2 paragraph mini essay. First paragraph is going to be basically reflecting on everything that you learned, everything that you read today in school. The second paragraph is going to be about your plans for the future. So let's go. Financial independence and investing. My favorite day of the school year. Let's do this. Quick recap, 30 seconds. What is financial independence? The student definition, the student-friendly definition that we're working with here lately is basically if you're financially independent, you have enough money to do whatever you want. You don't have to worry about basic financial moves that you have to make. You can pay for unexpected things like breaking appliances, car repairs, God forbid, medical emergencies, right? You can pay for your school, you can pay for your mortgage, your rent, your groceries, all of that stuff without worrying. And for many of us, that also means buying cool stuff. PlayStation 5. That's my big thing. One of these days I'm going to buy one. I always talk about it. Haven't bought one yet. Maybe a nice car, a nice piece of property. Maybe you want to go on vacation. Financial independence is basically setting your financial goal and hitting that goal so that you can do what you want and live freely without having to worry about money. All right? So, how do we reach that level? In my opinion, investing is what separates people in the upper class, the very wealthy people that you hear about, that you read about, that you see on TV. The difference between those wealthy people and the middle class or the lower class is that the upper class is investing. Everyone else is not. What's the definition of investing? What is investing at its core? First of all, you're using money from your surplus. This is the most important thing. You can't invest unless you have a surplus. So I talked about this once already, but I'll explain it again real quick. How do you get a surplus? Right? Every month you got to track your budget. How much income, here come the hands. How much income do you make? If your income level is here, your expenses might be here. Expenses is your rent, your groceries, your car payment, all that stuff that you got to pay for. You got to make sure that your income level, all the money that's coming into your bank account, usually through your job, through your paycheck, you got to make sure that's higher than your expenses. So you got to save money, keep your expenses down, get yourself educated, and get a good job so you can keep your income up. If you have low expenses and a high income, you're going to have a surplus. That's all the leftover money at the end of the month. What do you do with that surplus? You invest it. What is investing? That's when you buy assets that you think will grow in value. That's basically all investing is. You buy something that you think is going to be worth more later on in life. And I'm going to give you examples of 4 different assets that you can buy with your surplus. And remember, like I said, I do all of these things. I use all 4 of these strategies. That's called diversification. You don't want to put all your eggs in one basket, right? You don't want to bet your entire surplus, your entire life savings on one investment. You want to make that bet on hundreds or thousands of different little mini investments. That's called diversification. Here's one asset that you can buy. Stocks. What are stocks? We've probably heard this word. We've probably heard about the stock market. So what exactly are stocks and how do you make money off of them? Well, basically stock or owning stock is when you own a small portion of a company. It's pretty cool to own a pair of Nikes, right? It's pretty cool to own an iPhone or an Apple Watch. Love this thing. It's pretty cool to own those products. You know what's even cooler? Owning a piece of the company Nike. Yeah, I own a little piece of Nike, the corporation, or a little piece of Apple Corporation. Owning those products, that's great and all. Owning that stuff, trust me, I'm a big fan of Nike shoes and Apple products. I own them both. But I also own the companies themselves. All right? When the company grows in value, your stake in that company also grows. And when you're older, or you're ready to go buy a car, or you're ready to go buy a house, you can sell your stock in that company to make a profit. Let me tell you a little bit about dividends, okay? Certain stocks, Apple being one of them, Apple is just a great example, will give you dividends, okay? A dividend is basically when a company says, hey, thank you for believing in us. Thank you for owning stock in our company. Apple's latest dividend was 20 cents per share. So if you owned 500 shares of Apple, you would receive a dividend of $100. Basically, 4 times a year, you would get a check from Apple that you can do whatever you want with for $100 just for owning shares in their company. All right. Back in 2018, this is only 3 years ago, shares of Apple were trading at about $40 each. If you want to buy 10 shares of Apple back in 2018, that would have cost you about $400. Fast forward to today, 2021, 3 years later, today Apple shares are trading at about $133 each, right? So if you spent $400 back in 2018 to buy those 10 shares, today your 10 shares are worth $1,330. All right? You have more than doubled your investment. In fact, you have more than tripled your investment. That's a 225% return on your investment. Now, Apple is an example of a very profitable company. They are one of the largest companies in the world. All right, right now they're ranked at like number 2 or number 3 in the world. So obviously, I'm going to give you a positive example. For every positive example, there's a company that fails. Okay, so it is very risky to put all of your money into one stock. What if something crazy happens with that stock? What if the next iPhone is a complete flop? What if it has a defective battery that explodes and Apple gets a bunch of bad press and somebody burns their hand because their iPhone exploded, right? You don't want to put all of your money into one stock. Couple companies that you believe in, sure, go for it. But how do you own dozens, hundreds, or thousands of stocks all at the same time? Is it possible? Yes, it's possible. And in my opinion, the index fund is the greatest invention of all time. I love the GPS, right? I'm never going to get lost. I love the iPhone. It's a great invention too. Electric cars, really cool invention. I hope I can afford one someday. But to me, the greatest invention of all time is the index fund. It is literally my favorite thing to talk about, maybe in the entire world. All right, aside from maybe video games. No, I gotta say, index funds are more fun to talk about than video games. Okay, and here is why. Index funds allow you to buy dozens, hundreds, or thousands of stocks at the same time in a nice, convenient little bundle package. It's an amazing concept and it's only been around since the 1990s. Okay? So you might have heard these economic terms like the S&P 500 or the Dow Jones Industrial Average or the NASDAQ stock market. These are examples of indices, the plural for index. All right? Wouldn't it be cool if you could buy every single stock on the stock market? I mean, it sounds like fantasy world, right? Hey, you today at age 18 with one click of a button on your phone or on your computer, on that Chromebook that you're sitting on right now, wouldn't that be amazing if you could just buy every single stock on the entire stock market? It sounds wild, doesn't it? It blows my mind. But it is possible. You can do it. All right, I make it sound like it's such a special, crazy, cool thing. Literally, anybody on earth, as long as you're 18 or older, you can go and do that. That's why it's the most amazing invention that has ever been created, right? If you're able to do that, that's what separates, again, the wealthy people from all the other people in society. All right, wealthy people invest their money, and one of the tools that allows them to do it is the index fund. This is a nice, very cheesy looking, corny looking picture right here. Index fund investing made us millionaires, right? All you got to do is buy a total market index fund. Let's see how long it took for these people to become millionaires. If you were in class the other day, we did this exercise. Let's see how long it would take if you invested in index funds. All right, let's take a look at this. All right, this is called a compound interest calculator. This is going to help you predict your gains in the stock market. All right, now remember, this is all, entertainment purposes only. There is risk in investing in the stock market, right? But this index fund concept is one of the safest ways you can invest your money, right? Because you're diversifying between hundreds or thousands of companies all at the same time. All right. So the S&P 500 is the index that includes the 500 largest companies in the United States. Historically, the interest rate or your yearly profits on the S&P 500 are about 10% per year. That means if you put away $100 every year, you're going to get $110 back, right? 10% gains per year. So let's say you start your bank account with $500 in it. Just for an example, let's say you got $500 sitting there today. All right. Now I've already done this math, so I know what I'm about to punch in here. Let's say you put in $15.50 a day. $15 a day, that's pretty significant. $15 a day is a little tough to scrounge up. But let's say you're able to invest $15 a day. Now here, this field says annual addition. All right. So $15.50 a day is $5,657 per year. Sounds like a lot, when you put it in as yearly addition or annual addition, over $5,000. But remember, that's just $15.50 a day. $15.50. Let's let that money grow for 30 years. All right. You're roughly 18 years old right now. You're 18 plus 30 years. You're going to be 48 years old. So again, start off with $500. You're adding in $15.50 a day. You let it sit for 30 years. If the economy is just doing its thing, if it's going at its historical average, that means not a bad economy, not a great economy, just right in the middle, consistent with historical returns, you're getting 10% return on your investment per year. After 30 years, you end up with $1 million. $1,032,321.66 to be exact. This is the power of index fund investing. All right, this is like the life hack, you guys. This is the secret formula. Now keep in mind, this is not a get rich quick scheme. This is a get rich slow scheme, which is much more realistic and much safer. So I really hope that I have been able to share my enthusiasm, but also kind of show you the secret of index fund investing. All right. It is the simplest, the safest, and most popular way to grow wealth here in this country. All right. No portfolio is complete without some real estate. Real estate is a tough barrier to entry. Like, it's a tough asset to get your hands on, right? Because it is pretty expensive. It requires you to save a lot of money. What is real estate? It's land. And the buildings on that land. Pretty simple. You got different types of real estate: residential, meaning where people live; commercial, meaning where people do business. You've got industrial, which is like factories, plants, warehouses, and stuff. And you also have vacant land, where depending on local laws, you can choose to build something there if you want, or use it for, farming or hunting or something like that. All right. Owning real estate is just a great investing strategy, but again, it requires a lot of capital to get started. So, let's start with this example of buying a house, right? Say you spend $300,000 on a house. $300,000 on a house. You don't have to pay all of that up front. A 20% down payment would be $60,000. All right, that's pretty reasonable. If you have a really good surplus going, maybe you sell off some of your index funds so that you can make a down payment on your house. You would be left then with $240,000 in mortgage debt. How do you pay off that mortgage debt? Monthly payment, just like anything else in life. You pay your Netflix, you pay your monthly mortgage, right? Maybe your monthly mortgage payment is around $2,000. One thing that you can do is, if this is a multifamily house, you can rent out the apartments within that multifamily house, right? Say there's 3 apartments. You could sell one for, you could not sell, you could rent out one for 800. That's the smallest one. You could rent out another one for 1,000. And then there's one really nice bigger one on the top level. You can rent that one out for 1,200, right? The total of all that rent you're going to receive, right? How cool would it be to be the one receiving the rent checks, not paying the rent checks? You'd be making $3,000 per month. What did I say was that mortgage payment? Your mortgage payment that you're paying to the bank is only $2,000. So you're making a $1,000 profit every month on that building. It's a really great strategy, but you're going to be responsible for plowing the snow, fixing any broken appliances. If the toilet is not working at 3 a.m, guess who they're going to call? It's going to be you. You could, you could get a little stressed out by a job like that. But if you're a handy person, if you're interested in working in the trades, if you enjoy taking care of property and having pride in a piece of property, this is a great, great investment. Also, you don't even have to rent out your property. If you just bought a house for yourself and lived in it, that real estate, that investment is going to appreciate. Appreciate means grow in value. So check this out. This is an appreciation calculator. All right, I'm going to show you how your investment in real estate can become extremely profitable. So let's go back to our same house that we were just talking about. Let's say it costs $300,000. All right, forget about the renting thing now, where you're renting out your apartments to other people. I mean, you could be in this example if you wanted to, but imagine you're just living in your own piece of property. You're paying your mortgage every month, but you're building equity in this house. It's realistic, especially in Massachusetts, where real estate is expensive, for the appreciation rate of your home to grow at a rate of 5% per year. That's like average, all right? Remember how in our index funds are going to be growing at roughly 10% per year? Real estate is growing, but a little more slowly, 5% per year, all right? So let's say we let that real estate sit for a period of 30 years, okay, at a rate of 5%, all right? What is the final value? We're going to set this to yearly, right? What is going to be the final value of your house after a 30-year period? Your $300,000 house is going to be worth $1.29 million, all right? Just under $1.3 million. Now, that is a solid investment right there, to spend $300,000 and have it be worth $1.3 million at the end of 30 years. All right. A lot of people, when they retire, they get a little bit older, they want to move down to Florida, you want to move to DR, you want to move to California, you sell your house, $1.3 million is going to get you a lot more than, a plane ticket, right? They get you a plane ticket and two houses down in Florida, right? So again, if you buy something, a house for $300,000, it appreciates at 5% per year. You sit on it for 30 years, you pay off your mortgage in that time. Final value of your house, 1.3 mil. Not bad. All right, the final asset that we're going to talk about here is cryptocurrency. You might have heard about cryptocurrency, especially lately in the news, because the value of cryptocurrency is absolutely skyrocketing right now. All right, it's funny because cryptocurrency is digital currency. There are no actual coins. There are no actual Bitcoins or Litecoins or Ethereum coins, right? These are just images that are kind of used to help people imagine the fact that it's actual currency. But no, this currency lives online, okay? It is a way to replace traditional money. You see, the benefit of cryptocurrency is this. There's only a set amount of it, okay? Bitcoin specifically, there's only a set amount of it. The United States can print money whenever it wants. Okay, it has done so a lot recently. All right, that's one reason why we were able to get stimulus checks during the COVID-19 pandemic. Right, you can't just create more Bitcoin out of thin air the way that the United States government can literally just print money. So the value, in theory, is going to be set for a long period of time. Okay. It's a kind of a way of thinking it as like digital gold. There's only a set amount of gold in the world. There's only a set amount of Bitcoin in the world. That is what makes it valuable. That's why people want it, because there's only so much of it. You can always print more United States dollars, right? But you can't just create more Bitcoin. You can't just create more gold. Back in 2016, we're talking 5 years ago, one single Bitcoin cost $500. If you held on to that Bitcoin through all of these dramatic increases and steep drops, like the value is just going up and down, it's completely unpredictable, right? The value of those index funds, very predictable. The value of real estate, very predictable. The value of cryptocurrency, extremely unpredictable, right? Because it's a brand new thing, right? It has not been around for that long, like 15 years, right? But if you bought one Bitcoin for $500 in 2016 and you held on to it through all of these dramatic ups and downs, today that Bitcoin would be worth 50 racks. That's right, $50,000. That is an insane return on investment. $500 that returns $50,000 in 5 years. That's a 9,900% increase, or 155% per year. 155% per year. Remember our index funds? Those were going up at 10% per year. Remember our real estate? That was going up at 5% per year. All right, Bitcoin grew at 155% per year. Okay, that's insane. That's absolutely insane. Don't bet the farm on crypto, okay? Again, educational and entertainment purposes only. I'm not a financial advisor. You can invest a little bit in cryptocurrency as a speculative investment, but the dramatic ups and downs in the crypto market, you really don't want to bet a ton of money on cryptocurrency. That's just my opinion. Take it for what it's worth. It's cool to be a part of this movement, right? You can see it as a true currency. You might truly believe in the idea of cryptocurrency, replacing or at least supplanting regular money. Or you don't care about, actually going and buying a pizza with Bitcoin. You just see it as a speculative investment, right? Either way, right now it's very volatile, right? It's very volatile, it's very risky. The value can go up or down a lot, right? So you know, it's cool to have it, but it's not cool to risk like your life savings on it, right? But it's definitely something to continue researching and keep your eyes on, because the technology behind it is really cool, really interesting, a really fun thing to learn about. So here we go, everybody. Day 3 vocab, complete it. All right, you're already there in the doc. Go for it, complete it. Next thing you're going to do after you take your quick 5-minute break, chill out, relax for a few. Day 3 reading. You're going to go into the details of all four of these assets, right? Stocks, index funds, real estate, and cryptocurrency. And then you're going to move on to day 3 writing after another short break. You're going to write about what you learned. You're going to write about your plans for the future when it comes to investing. Remember what I said earlier. What's the difference between the wealthy people and everyone else? Wealthy people invest. Period. If you can create a large enough surplus and invest and make safe, responsible investments backed in research and facts and using history to inform your future decisions, you're going to be just fine. You're going to be financially independent. All right. I want you guys to explore this topic with me. I want you to ask all sorts of questions today in class, because, as you already know, I'm very excited about this topic. It's one of my favorite things to talk about. All right. I hope you enjoyed this video, everybody. Let me know if y'all need any help. I'm Mr. Oza. This has been Investing 101, and thank you for watching. Have a great class.